Hello guys, and welcome to another educational video. My name is Styliana. I'm the head of investments and market research at Pure, and in today's video we're going to discuss about a very popular investment strategy, the dollar cost averaging. Before we start, I have to make sure that you already know that this is not financial advice. We create high quality information videos, but only for educational purposes. Active trading can be stressful, time-consuming, and still yield poor results. However, there are other options out there. Like many investors, you might be looking for an investment strategy that is less demanding and time-consuming, or just a more passive investment style. But what if you want to invest in the markets but don't really know how to start? More specifically, what would be the optimal way to build a longer-term position? In this video, we'll discuss an investing strategy known as DCA, or dollar cost averaging, which provides an easy way to mitigate some of the risks of entering a position. Now let's see, what is dollar cost averaging? Dollar cost averaging is an investment strategy that aims to reduce the impact of volatility on the purchase of assets. It involves buying equal fiat amounts of the asset at regular intervals. The premise is that by entering a market like this, the investment may not be as subject to volatility as if it were a lump sum, for example, a single payment. Buying at regular intervals can smooth out the average price. In the long term, such a strategy reduces the negative impact that a bad entry may have on your investment. Let's see how DCA works and why you might want to consider using it. The main benefit of dollar cost averaging is that it reduces the risk of making a bet at the wrong time. Market timing is among the hardest things to do when it comes to trading or investing. Often, even if the direction of a trade idea is correct, the timing might be off, which makes the entire trade incorrect. Dollar cost averaging helps mitigate this risk. If you divide your investment up to smaller chunks, you'll likely have better results than if you were investing the same amount of money in one large chunk. Making a purchase that's poorly timed is surprisingly easy, and it can lead to less than ideal results. What's more, you can eliminate some biases from your decisions making. Once you commit to dollar cost averaging, the strategy will make the decisions for you. Dollar cost averaging, of course, doesn't completely mitigate risk. The idea is only to smooth the entry into the market so that the risk of bad timing is minimized. Dollar cost averaging absolutely won't guarantee a successful investment, as other factors must be taken into consideration as well. As we've discussed, timing the market is extremely difficult, and even the biggest trading veterans struggle to accurately read the market at times. As such, if you have dollar cost average into a position, you might also need to consider your exit plan. That is a trading strategy for getting out of the position. Now, if you've determined a target price or price range, this can be fairly straightforward. You again divide up to your investment into equal chunks and start selling them once the market is closing in on the target. This way you can mitigate the risk of not getting out at the right time. However, this is all completely up to your individual trading system. Some people adopt a buy and hold strategy, where essentially the goal is to never sell, as the purchased assets are expected to continually appreciate over time. While there are short-term periods of recession, the Dow has been in a continual uptrend. The purpose of a buy and hold strategy is to enter the market and stay in a position long enough so that the timing doesn't matter. Dollar cost averaging is a redeem strategy for entering into a position while minimizing the effects of volatility on the investment. It involves dividing up to the investment into smaller chunks and buying at regular intervals. The main benefit of using this strategy is the following. timing the market is difficult, and those who don't wish to actively keep track of the markets can still invest this way. However, according to some skeptics, dollar cost averaging can make some investors lose out on gains during bull markets. With that said, losing out on some gains isn't the end of the world. Dollar cost averaging still can be a convenient investment strategy for many. That's all for today, guys. So if you have any questions or if you want to open a trading account with us, you can contact us through our website or our social media. We'll be more than happy to help you. Thank you for watching and wishing you a profitable trading week.